A Roth Individual Retirement Account (IRA) is a retirement savings account that a person can contribute to each year and, under certain circumstances, funds can be withdrawn tax-free. The money saved in a Roth IRA can be invested in financial instruments such as equities, bonds, or a savings account. Contributions to a Roth IRA are made with after-tax money, meaning that the contributions are made after income taxes have been withdrawn from the account holder's paycheck. Hello everyone, and welcome to my channel. Today we will discuss about the good and bad of a Roth IRA. If you are new here, then please subscribe to my channel and hit the bell icon. Roth IRAs offer a long-term tax benefit since withdrawals of contributions and investments earnings are not taxed in retirement. However, Roth IRAs may not be the right retirement account for every individual. Although there are benefits to Roth IRAs, there are also distinct disadvantages that should be considered. Here are 5 top benefits of Roth IRA. Number 1. Tax-free growth and withdrawals. Roth IRAs are one of the best vehicles to save for retirement, given the tremendous benefit of tax-free growth. With a Roth IRA, you contribute after-tax money to the account, so you don't get to avoid tax on your contributions, as you might with a traditional IRA. In exchange, your money grows tax-free, and you'll be able to withdraw it tax-free at retirement, defined as age 59.5 or older. Number 2. Pass down your money tax-free to heirs. While it can be easy to overlook, the Roth IRA is a great wealth transfer vehicle. The Roth IRA allows you to pass any money in the account tax-free to your heirs. Depending on the circumstances, heirs could still grow the account tax-free for years, maybe decades. But because the money is in a Roth IRA, any distributions will ultimately be tax-free to recipients. Number 3. Withdraw contributions penalty-free at any time. Unlike some retirement accounts that can dig you with penalties if you need to withdraw some money before retirement, the Roth IRA allows you to withdraw contributions at any time tax and penalty-free. The key word here is contributions, that is, only the money you've added. If you take out earnings before you're able to make a qualified withdrawal, you'll owe taxes on them. So, a Roth IRA can offer you a lot of flexibility if you run into an emergency and need to access cash. While experts advise not tapping your account, sometimes you don't have a choice, and it can be a relief to know that you can do so without the extra burden of taxes and penalties. Number 4. No age limit for a Roth IRA. Your age does not prohibit you from contributing to a Roth IRA. As long as you have earned income from working, you can contribute to the account and take advantage at any age. Your contribution can be no more than $6,000 of your earned income, whichever is less. However, those over age 50 can contribute an extra $1,000 per year. In addition, non-working spouses can contribute to a Roth IRA if they have a spouse who earns income. Number 5. Roth IRAs don't have required distributions. Roth IRA does not have required minimum distributions, RMD. As the name suggests, an RMD forces you to take a minimum distribution from your account at least annually. With an RMD, you'll be forced to withdraw money whether you need it or not, and that means taxes and a halt to the tax-advantaged compounding inside the account. But the Roth IRA avoids required minimum distributions entirely, meaning you can compound as long as you like, even passing that money untouched to your heirs tax-free. Let's have a look on disadvantages of Roth IRAs. Number 1. Roth IRA contributions aren't tax-deductible. A traditional IRA allows individuals to make before-tax contributions for retirement, and these funds aren't taxable until the year they are withdrawn. In the same way, a 401k plan or other type of employee retirement plan allows employees to contribute to a retirement account through their employers and then take a tax deduction. But if you contribute to a Roth IRA, it must be with after-tax dollars, so your contributions aren't tax-deductible. You must pay the taxes on the income before you make the contribution, and you can't defer the taxes to a later year. Number 2. The maximum contribution is low. The Roth IRA contribution limit is $6,000 in 2022 and $7,000 if age 50 or older. Traditional IRAs have the same contribution limits. That's not a lot. You'll probably need to invest elsewhere, such as in a 401k or have enough for retirement. A 401k has an annual contribution limit of $20,500 in 2022 and $27,000 for those age 50 or older. Number 3. Penalties for unqualified withdrawals. You may be penalized with an additional 10% tax on the amount of the distribution. Penalties may apply if you take a distribution within 5 years from the first tax year of your account, or if you take the distribution before age 59 and a half. You or your beneficiaries aren't penalized if the distribution is held for at least 5 years and is, due to disability, upon or after death, or used for qualified higher education expenses. You can take a one-time distribution to help buy your first home. Number 4. Employers can't set up Roth IRAs for employees. Employers have several options for setting up and contributing to retirement saving plans for employees, but these don't include Roth IRAs. Employers can't set up Roth IRAs and make direct contributions to them for employees, but any employee can use income from work to make their own Roth contributions. So guys, that was all about today's topic. See you soon in the next video. Goodbye.